Welcome back to our 7-part video series that goes into detail on a new business roadmap from getting off the ground to year 3 of your business. The goal is to help you prevent the many headaches new trucking companies face. Before we dive in, I want to thank all our new subscribers out there keeping the channel growing. I want to especially call out Rowan. You are awesome. Keep it up. If you enjoy our content like Rowan does, give this video a like, leave a comment, say hi to Rowan, and don't forget to subscribe. In the last video, we talked about knowing what lifestyle you want as a new trucking company. If you haven't watched it, go check it out. There are a lot of questions you should answer before moving on to the next step of your new venture roadmap. Now, let's move on to part 2, where we will discuss pre-startup planning for your business. It is an important one. The choices you make from this point forward greatly impact your company's startup cash flow, growth timeline, and large future payment dates. A solid business plan will list expenses and revenue expected in your new company. Expenses can be up to $20,000 per month as a single owner-operator startup, so be sure to put aside money for the investments needed for your new career, as this is the biggest reason new trucking companies fail. Did you catch that? The biggest reason your business may fail is not being prepared for the large costs involved in the trucking business. So what should you prepare for? First, don't forget your own salary. I mean, you are a professional driver. Get paid for it. Next, there are the startup costs that include the trucks and trailer payments, licensing fees, and registration costs. Third, your commercial insurance payments, which won't be cheap. Fourth, any required data tracking software and services like a telematic device or ELD for your electronic logs. Fifth, be prepared for paying your taxes. Not only are there the quarterly IFTA and IRP mileage tax reports, but annual business taxes as well. Sixth, you can't forget about your daily operating expenses such as food, fuel, and more. And seventh, you always need to be prepared for vehicle maintenance issues. You never know when an issue will happen, so have a rainy day fund for your business to be ready. Of course, if you haven't received your CDL yet, the last expense to consider is the cost of getting your CDL. Truck driving schools typically cost between $5,000 and $10,000, while one-on-one CDL training, like at our CNS Driver Training Center, can cost between $2,000 and $3,500. If you start your company first, there is a way to have your CDL training be tax deductible as on-the-job training or company contract training, as long as it is paid for by the company entity. Have CDL questions? Let us know in the chat or click the form linked below and we will answer them. With that said, there is only one way to receive free CDL training. Find an employer who is willing to train you themselves or pay for your CDL training. This is referred to as company-sponsored CDL training, and you should expect at least a 1-year commitment after training to that company. We have a list of these companies on our CDL job board for the PA area. You can find it linked below. Now, when starting your trucking company, don't forget the old adage, location, location, location. Why? Where you choose to start your trucking company could save you thousands on insurance, and here are 6 specific reasons. 1. Your startup business location is important and can save you thousands of dollars in insurance premiums when you first start your trucking company. In most cases, it is best to avoid major cities or areas susceptible to severe weather. For example, trucking insurance is expensive in Atlanta, Georgia. However, a new carrier can save thousands of dollars if they just start the location of the business outside of the city. 2. Location consistency is important. It is best practice to live and have your driver's license in the same state that your business will be located in. If your place of business has an address in New Jersey, the insurance company expects your driver's license to be in New Jersey as well. Additionally, if you declare to your insurance company on your application that you are going to operate within a 500-mile radius of your New Jersey place of business, yet you have a Florida driver's license, that causes yet another unexpected mismatch. If there is a mismatch, you will almost always see a significant insurance premium increase. 3. Garaging address location is important. In general, living in an urban area compared with a rural area can have a major impact on rates. In a metro area where there are more cars on the road and more traffic, accidents are more likely, pushing rates higher. If you plan to make the changes to your garaging address, it is recommended that you notify your insurance company as soon as possible. Your insurer can make the necessary adjustments to your insurance policy to protect you against possible risks. 4. Delivery radius is important. Most insurance companies want you to stay interstate or within a 500 air mile radius of your business location for the first couple years of business. As you prove your safety history and show that you can manage the company well, then expanding to long-haul trucking will be more affordable. If you are committed to start as a long-haul trucking business, then expect to pay expensive insurance premiums for a couple of years. 5. Employing out-of-state drivers can be expensive. If you want to grow your young business by adding new drivers, insurance companies want these drivers to stay within a localized 500 air mile radius location for the first couple years until you gather more evidence of good business management and safe driving history. For example, out-of-state drivers tend to cost $10,000 per person in insurance premiums for startup carriers. It is recommended to not use out-of-state drivers for the first 3 years of business. And 6, routes matter too. Underwriters also look at the location of frequent routes your drivers travel. Insurance companies are big fans of regular routes as it lowers the overall risk of an accident because the more regular routes you operate in, the more familiar your drivers are. However, the location of these frequent routes could negatively affect your risk as well. Underwriters use road safety data that highlight the more dangerous roadways to map out which states, metropolises, and cities are the riskiest to travel in. Have any other insurance questions? Let me know in the chat or click the form linked below and we will answer them. Now that we understand why location matters, what about cash flow? The biggest reason owner-operators fail is not having enough money saved up before going on their own to manage the startup costs, the maintenance emergencies, or lagging payments after finishing a load. Cash flow is the amount of money coming in versus coming out of the company. The issue for owner-operators at the beginning is not having money coming in for at least 30 days after completing their first few loads. That's right. You may have finished 3 or 4 loads in a day or a week, but on average, you won't be paid for it until 35 to 45 days later from the company invoice. Owner-operators need to have money on hand to pay for fuel, insurance, food, and more for the entire month before the money enters the bank account. So, truck drivers who are looking to go on their own must find a way to start a savings plan where you are regularly putting aside money, at least $200 per week. While on average, truck expenses alone for a new owner-operator is usually around $15,000 to $20,000 per month for a single truck. Before starting out, you have to save up at least twice that to manage the first couple of months of your business. Ideally, many consultants recommend saving at least 6 months of operations, which is closer to $100,000. As you build your savings, you should learn how to build and use your credit score for when you later need to borrow for a truck purchase or repairs. Knowing that vehicle payments affects cash flow, the question comes down to, should you purchase or lease a new or used truck? Well, think of it this way. As your most expensive and most important asset, a used truck will likely cost around $60,000 or more, while a new truck will cost $100,000 or more. To get a new truck, most dealerships require 2 years of driving experience, a clean driving record, 20% down payment, and a credit score of at least 650. Many new owner-operators cannot afford to put 20% down and will often choose to lease the truck with around $1,000 down payment. In the short term, leasing is always cheaper because leasing focuses on the value of the truck at the end of the lease term, lowering the initial investment with an option to purchase or refinance the remaining value of the truck after the lease ends. I know this sounds complicated, but here's an example. A $150,000 truck is leased to own for 4 years. After 4 years, the value of the truck is worth $50,000. So during your lease, you are paying off the difference in the value of $100,000. And then you still owe $50,000 at the end. Now, during the last 4 years, your business plan would be to save money to purchase the rest of the value of the vehicle at the end of the lease or refinance for the residual left on the truck. The average cost to lease a semi-truck is between $1,600 to $2,500 per month for new trucks and $800 to $1,600 per month for used trucks. Don't forget that there is still likely around $1,000 down payment if you're leasing from a dealer. I get it. This all sounds complicated, but this is why I am stressing why knowing what you are getting into is so important. Driving truck and running a business is completely different, but that is why CNS is here to help. The essentials are essential on purpose. So check out this video where we chat about DOT essentials for a new trucking company. And don't miss it. As I mentioned earlier, if you are enjoying our content like Rowan does, give this video a like, leave a comment, say hi to Rowan, and don't forget to subscribe. Part 3 is just around the corner. Stay tuned.